So let me start by introducing Bob. So first and foremost, thank you everyone for joining. Today we have with us Bob True. Bob is the founder and CEO of Barnegat Fund Management, which is a relative value fixed income hedge fund. He's a standout in the investment world, and he's known for his unique methods and impressive achievements. Under his leadership, the Barnegat Fund has seen a total return of 1,647% in 23 years. That translates into a compounded annual rate of 13.3% net to investors. What is perhaps even more impressive is that he has achieved this with almost zero correlation to traditional asset classes. This success places Barnegat at number one out of more than 30,000 funds in its category on Bloomberg. Bob runs Barnegat with a small but dedicated team that focuses on finding opportunities where others might not look. At 52, Bob is known for doing things his way. He doesn't spend much time on marketing and instead dedicates himself to investing and deep research. Barnegat is also known for consistently returning capital to its investors. His success and the fund's performance have therefore been recognized by major publications such as the FT and Bloomberg. With that, I invite Bob to start his presentation.
Thank you. You can hear me okay?
Yep, I can hear you fine, Bob.
Great. And so just to be clear, anytime anyone has questions, I don't mind being interrupted. Anytime you want to ask anything, because one of my pet peeves is when I listen to other presentations and they start using esoteric words and such, and I get all confused. So anytime I'm using a word or something is not clear, feel free to interrupt me. I'm happy to go over it again. So just the first page here, just highlighting, just to kind of start how the last 23 years have been. Bloomberg has 30,409 funds, as Vasu mentioned, and there are 30,409 fixed income funds, and we're number one since our launch in 2001 on those. And as he mentioned, it's about 13.3% a year. And you can see here just the graph of our share price on the same scale as the S&P and bonds and such. And then on the bottom, you can see the correlation but from our fund to the major investment groups around the world, so that we haven't had much correlation. It's slightly positive, but not much correlation at all. Just as one question again, can you see my cursor when I point at stuff on the page, or you just see the page?
I can see both the cursor and the page.
Okay, great. Okay, so the second page, I just was going to highlight how has Barnegat outperformed? Like, what do we do that has led to that performance? And the big thing we do is making money from the non-economic decisions of others. We trade bonds, interest, it's all fixed income with a little bit of currency for an exchange. We trade bonds, interest rate swaps, futures, options, volatility, and other related products. We're looking for relative value mispricings between those products. And a lot of times, these products and mispricings are somewhat permanent and long-lasting. So one thing I think that's different about Barnegat than other hedge funds is we put trades on and then we hold them for years. You know, I know a lot of Wall Street says, hey, I'm going to buy this stock and here's the catalyst why things are going to change. And they try and make their money that way. Barnegat is long-term oriented. We put the trades on and we hold them for, I would say on average, 1 to 2 years, and frequently longer than that. Like the product that we have held the longest is right now, it's about 15 years. We have an interest rate swap that is about 15 years old. And one of the things that allows us to do this long-term type trading is that our investor base has been great. It has been very stable and long-term focus. About half of our assets have been with us since 2001. So that allows us to hold these trades for long periods. And then one other interesting thing I was going to get into is that sometimes these trades never correct. You know, I talk about people looking for a catalyst and the trade's going to change and that's how they're going to make money. One of the things Barnegat does is we put on some trades on things that seem like they're never going to correct, and we just collect the coupons off those. One of the things I highlighted here on, I think of Barnegat as two funds in one. There's the fixed income relative value hedge fund, and that is the relative value trades, which I'm going to go through here in a moment. We trade around the world, US, Canada, Mexico, all the countries in Europe, plus like the Far East. And these trades, you can think of it kind of, let's say we had a bet on Manchester United versus Liverpool. We don't exchange any money up front. These trades cost zero on day one. But then once the kind of the game has been played in the Manchester United versus Liverpool example, or once the swap has occurred or the time has elapsed, then the payments take place. So our fund, that's one important thing to remember, that these relative value trades that I'll talk about cost zero on day one. So then the second part of the Barnegat fund, where I think of Barnegat as two funds in one, is the Global Cash and Bond Mutual Fund. So let's just say our fund is roughly 500 million bucks. We have 500 million that we need to invest. The counterparties, when we do these relative value trades, are going to want collateral to support those trades. And we just buy cash or currency, foreign currencies or US cash, or developed world government bonds. And then we post those products as collateral with the exchange or with the counterparties to support our trades. So I think of that portion of the fund as a global cash and bond mutual fund. So no leverage, no tricks, just 500 million. We have to buy 500 million worth of stuff, and then we post that with the counterparties. So then our fund's return combines the yield from what I refer to as the mutual fund, which has no leverage, just owns assets, and then the fixed income relative value hedge fund, where we put those relative value trades on, and they don't cost anything on day one. So those two together make the return of Barnegat. And so one of the questions on Barnegat profits from the non-economic decisions of others, a natural question would be, why would anyone make a non-economic decision? So in many cases, that's because they have much bigger issues that they are battling. And so Barnegat is just focused on the economics, and they have other issues they're working on. So one big example, which was great for us, was quantitative easing. That was fantastic for Barnegat. The central banks wanted 2% inflation. That was their target. That's what they were trying to do. And then in the financial crisis of 2008, they undershot that target. Inflation was too low. So they began to print money to buy bonds. And so here, just on this example, I used the UK, but all the countries were pretty similar. And so the UK starts to print money to buy bonds on the hopes of raising bond prices and lowering yields and spurring the economy on with those low yields. And then hopefully inflation will go up and they'll get the 2% that they want. And on this question of non-economic decisions, did the Bank of England care about distorting the bond markets? Yeah, a little, but not really. Their focus was 2% inflation. That's what they were aiming for. And if they had to kind of mess other things up on the way to there, they weren't so bothered by that. And so I just started with the example of their calendar year 2008, 2009. The Bank of England said, hey, initially they said, we're going to buy 50 million of gilts. Gilts are their name for their treasuries, corporate bonds and commercial paper, between 5 years and 25 years. Now, eventually, subsequently that year, they raised the purchase size to 200 billion, and they changed the maturities from 3 years up to 50 years. But you can see just size-wise here on this intervention that 200 billion, the gilt market coming into that was only 426 billion. So they bought back 40% of all gilts outstanding. That's an enormous amount. And that creates, so that's what creates these mispricings for Barnegat. This is a perfect example of a non-economic decision. They want to get 2% inflation. On their path to get 2% inflation, they distort the bond market, and that's right up our alley. So here, just to illustrate how the quantitative easing distorted the yield curve, here you can see this is what the yield curve, the forward path of what the yield curve looked like when they began to buy bonds in 2008, 2009. So you can see the initial thing, they said, we're going to buy from 5 years to 25 years. And the reason they did that was from 0 to 5, they didn't want to mess up their short-term rate. All the central banks control the short-term rate in the economy, so they didn't want to affect that. So they said, hey, we'll leave the short-term part of the curve alone. And then they didn't want to mess up the long-term part of the curve because that's where pensions are involved. And so they left that alone as well. So they just said, hey, we're going to intervene here and just buy gilts. We're not going to buy linkers. Linkers are the English version of tips. And we're just going to buy between 5 years and 25 years. And they bought a massive amount, 40% of all gilts, and they just bought it in that sector. So you can see from the graph that it really distorts the yield curve. So in 2008, 2009, the UK government was running a large deficit because it was the global financial crisis, so they had to issue as many bonds as possible. Bank of England is in there buying as many bonds as possible, but the UK government was issuing across the curve, whereas Bank of England was just buying in this area. So you can see that it really distorted the curve. So the trade that Barnegat does is we go in and we pay around the 5-year area. You can see, let's see if my cursor, yeah, you can see kind of, the low yields down here. This is where we pay. And then we receive in the shorter end, kind of around the 3-year area, and the longer end. And so we are just happy to sit with that trade. Obviously, we're receiving higher rates than we're paying. So let's say that nothing happens and the Bank of England just keeps chugging along and they're in there buying the bonds that they want, and this mispricing remains as it is. One thing that is very nice for us, as time passes, we're receiving higher yields than we're paying. So that works great. We make money there. And now if they step back from the market, hopefully the curve would normalize. That's what we're hoping for. Now, what happened in reality, though, was the Bank of England comes in and they intervene. I mentioned initially they said we're going to do 50 billion. And then by the end of the year, they were up to 200 billion. So they intervened even more. They weren't getting the inflation that they wanted. And so Barnegat loses money in that situation because there was a distortion. And then they intervened even more, and the distortion got larger. So that's how Barnegat loses money, on mispricings getting more mispriced. But I was very happy with this trade and confident with this trade. We have to be able to bear mark to market. I'll get to that kind of towards the end of the presentation here, the risk management of Barnegat. But so we lose money. We have to meet those margin calls. We post collateral with the counterparties, but we continued to hold the trade. And then as the trade got more distorted, we put on more of the trade. And so, down here, you can see the initial intervention was 5 to 25 years, but then they were buying so many bonds and were having trouble buying all the bonds they wanted to buy to get inflation back up to 2%. They changed their maturity range to 3 to 50 years. So all of a sudden, these bonds, which had not been purchased originally and that we owned, were now part of the purchase. So these yields came way down when the Bank of England started buying, because they were buying so many gilts. It just brought these yields down. So our trade did pretty well when they changed the maturities. Now, what happened a few years later, Bank of England finally got to the 2% that they wanted, and they stepped back from the market and the yield curve normalizes. So we have an agreement to pay these low yields down here, receive these high yields. When the yield curve normalizes, it just looks like a much flatter line. So our agreement to pay the low rates and receive the high rates, that makes a lot of money quickly once they finally step back from the market. But that kind of thing takes years. This trade and all our trades take years to sort themselves out. So I think that's one advantage that Barnegat has, is that there's not many people in the market who know that they're going to be able to hold a trade for years. So, the multi-strats are very big and very important now. But one of the things that they're famous for is their tight risk management, that if you lose 5%, they cut your position in half. And if you lose 7%, you're out of a job, that kind of thing. So that's one of the difficult parts of fixed income relative value trading. As I mentioned here, this curve got distorted and the Bank of England didn't get the 2% inflation they wanted. So they increased the intervention. And so it got even more distorted and we lost money. One of the important parts of fixed income relative value is being able to hold the trade. That is the most important part. Can you hold the trade? And if it moves against you, now you have a better trade. Can you do more of the trade at that level? Do you have enough excess collateral? That's a super important part of fixed income relative value trading, being able to hold the trade until the end. So, we had enough excess collateral. We had other trades on that were doing well at the time. So this all worked perfectly, but eventually Bank of England gets the 2% inflation they want. The yield curve normalizes and it worked just as we had hoped. Now, just to be clear, it takes years for that to sort itself out. I don't want to make it sound like it happened in a day or a week. This takes years. Bank of England was in there. As long as Bank of England's intervening in the market, that distortion is going to remain distorted. And then years later, when they finally get the 2% they want, then they step back from the market and we're able to make the money. But so the important points are, like, while we're sitting there waiting, we're receiving higher than we're paying. So we make money on that. And then additionally, once it normalizes, then we're able to make all that we had hoped. So just on the theme of, these non-economic decisions, this was kind of government intervention chasing another goal of 2% inflation, and they distort the bond market. So here's one other example on people making non-economic decisions. This is panic. And so, humans are human, and they will act as such. And so in 2008, Lehman, goes under in the fall of 2008. And Lehman held a lot of tips as collateral, just like Barnegat does. And as they went under, people knew that Lehman would have to sell the tips. So there's a lot of front runners in the market. So they begin selling tips. And then similarly, because the economy is going in the tank in late 2008, what is the safest product in the world? Everybody wants to own treasuries. Whenever there's a panic, people want to own treasuries. And so you can see the yields here. So this is the graph. The blue line is the yield of this 2014 treasury. And then the black line is the yield of 2014 tips. Now that's after you hedge out inflation. So remember, tips pay you a real yield, and then they pay you whatever inflation is. So you can trade inflation, you can lock in inflation if you wish. And this black line represents if you locked in inflation and fixed all your cash flows, just like a treasury, the cash flows you're going to get. If you hedge out inflation, the cash flows you'll get from a tips. So here you can see on this red line is the difference between the yield on tips, which is usually a little bit more, 15 to 35 basis points more. And then the yield on the blue line is the yield of the treasury, and the red is the difference. So you can see for years, tips yield a little bit more. Any new product that's a little quirky usually yields a little bit more than the standard product like treasuries. So that's all fine. That goes as it is. We don't have any trade there. Here, Lehman goes bust, and you can see this trade goes haywire. And again, look at the yield on the tips. The yield on the tips goes up because people know Lehman holds them, and people just want to sell everything and buy treasuries. So the yield on tips go up. The blue line here, the yield on the treasuries go down. And the difference between the two, even though they're the same maturity, same government, same credit, same everything, the difference in yield between those two goes all the way to 2.5%. So that's right up Barnegat's alley. But here's the important thing, or one of the important things. We started putting this trade on when it was 125 basis points mispriced, like right around here. I thought that was the greatest trade I'd ever seen. 2 US government bonds yielding 1.25 different with same maturity, same credit, same government, same everything. So we put the trade on here. Obviously, that was a mistake in the short term. This trade goes all the way up to 2.5% misprice. And again, the important thing, the fixed income relative value is, can you hold the mispricing? Can you hold the trade? So once again, we had enough excess collateral. We meet the margin calls because at this point, we're losing money on the trade because we initially had agreements to receive 1.25 more on our tips relative to our treasuries. And it goes all the way to 2.5%. So here you can see in this box or this table, you can see the cash flows of how this trade works. So we buy the tips, we receive 3.74% plus inflation, whatever inflation turns out to be. We chose to hedge that inflation out and agreed to receive 1.36 in exchange for inflation. So the expectation for inflation in 2008 was low. So now we have a yield of like 5.1% on these tips. So we know the cash flows, and it costs us, I just said, let's say it costs us $1 million to receive 5.1% if we buy one of those. At the same time, we short a treasury. We're going to owe, when we short that, we're going to owe 2.5%. We get the $1 million from the short. So the cost, as I mentioned earlier, costs on our derivative trades are 0. So there's a perfect example. We buy a tips, costs us $1 million. We short a treasury. We take that $1 million back in, and we have set up for 0 cost. We've set up a revenue stream of 2.5% a year. Now it sounds great, and it was great. It's just this trade can run you over. Anything can happen. You have to be able to post the collateral to meet any margin call. And as I mentioned, we started putting this on at 1.25 mispriced. It went all the way to 2.5%. Now we added to this trade as it gets worse, as it gets more mispriced, I should say. But you always have to be able to meet the margin calls. That's the tricky thing. Even if you know you have an arbitrage, the market doesn't care. Whatever the market does, you just have to meet the margin call. Even if it's an arbitrage, even if it's an obvious mispricing, the counterparties don't care. You just have to meet the margin call. So that goes crazy in the end of 2008, beginning of 2009. And now one thing you'd think, again, I mentioned Barnegat's different because we hold our trades for years. You would think 2 US government bonds, 2.5% mispriced every year, cost of zero with a revenue stream of 2.5%. That's crazy. But even in US government bonds, it took about 3 years for that trade to sort itself out. So, you think, oh, this is going to snap back tomorrow. It took you can see 3 years from here all the way back to here, where the yields became equivalent again. 3 years time just for that to sort itself out. So Barnegat, when it's more mispriced, we hold more of the trade. As it becomes less mispriced, we'll hold less of the trade. But this is it's an excellent example on the sense of we lost money initially. You have to meet all the margin calls. The trade gets more and more appealing. We want to hold the trade because now it's even more mispriced and we want to add to it. You have to meet the margin calls. And then another important point is these things don't snap back instantly. They take years to sort themselves out. All these problems usually are so big. So in this case, it was panic. In the case of the UK example, it was government intervention. Those things don't go away instantly. And that's an important point to remember. So then next thing, just on risk management, I've talked about this a little. The big thing is being able to hold the trade. So here I refer to, the risk to Barnegat is, can we hold the trade? When you have a mispricing, it can always become more mispriced, even on an arbitrage like TIPS treasuries, simple US government bonds being mispriced. You have to post margin if you lose money initially. Now, conversely, if you make money, they'll send you margin. And obviously, if you take it off, you can recognize your profit. Or conversely, like in the case of long-term capital, all of their trades, all of their fixed income trades, they were right on every single one of them. But they didn't have enough margin to meet the margin calls. And that's why they went under. And that same thing can happen to Barnegat. Here, the things that worry me is how volatile is our share price. So this is the volatility of our share price for every single year for the 23 years we've been in business. And our target is 8 to 10% volatility. So you can see we've pretty well hit that. The one big error was here in 2008. The world got way more volatile than I anticipated, and we had to post a whole lot more collateral than I anticipated. But we had enough, here down on the bottom. Right now, to combat this risk of volatility, we hold about half the fund as excess collateral, as in the fund. It's just sitting there in the bank doing nothing. So in situations like 2008, we lost 37% in 2008. It was brutal. Like if you go back here, you can see here's the drop, the 2008. You can see us as the blue line. Bam, the thing drops. And, at the time, we went from a $3 share price to a $2 share price. And, with a scale of now we're at $17, it doesn't look like a big deal. But believe me, it was brutal. And at the time, when our share price was just $2 or $3, it hurt. And so that's the big thing about fixed income relative value. Can you hold the trade? So, we suffered through that loss. We had other trades. It's not like we just have one trade. We had trades, but they were all in this similar vein of a mispricing, getting more mispriced. And our fund lost money as the world panicked. You have to be able to meet all the margin calls. So one of the big important things is we hold about 50% of the fund generally in excess collateral. So you can compare that to, this is 1 year, one standard deviation, the volatility, just like you measure the VIX or any option on stocks. This is 1 year of volatility, an annual volatility. And so we have about 8 to 10%. So to blow through 50% of the fund, you'd need 5 annual standard deviations or 6 annual standard deviations, given our 8 to 10% volatility target. So, it can happen. Those things have happened, but that's kind of the risk management. The most important thing is trying to avoid the long-term capital scenario. They were right on every single trade, everything they had on in fixed income, just to be clear. They had branched out into some equity stuff that got destroyed. That's a separate thing. But in their initial niche, their initial expertise of fixed income, all those trades were winners eventually, but they couldn't hold them. And so that's the important thing. That's the important risk management to Barnegat. Can you hold the trade? How volatile is your fund? Because anytime you lose money, you have to meet a margin call. So as I mentioned, 2008, we lost 37%. But when your excess collateral is more than half, 50% is a greater number than 37%, we're able to meet all those margin calls. and it worked great in the end. But so it's, you can see back here, the fund, we held the trades. All these gains right here are the exact same trades on the losses here. We didn't really change anything. And so you can see the fund came back within 5 months. We were back up to our high watermark. So that was a very difficult time, but we recovered it within 5 months. So that was it was tricky, but that's the secret to fixed income relative value. So so you can see our volatility recently has been much closer to the 8 to 10%. Basically 22 of the 23 years have been right around the 8 to 10%. Just, this year, 2023, we had a 22% return, which was great. Volatility was much lower than I anticipated. I thought that our vol would be around 8 to 10%, but correlations, we hold about 15 to 20 trades. The correlations between the trades were much more negative than I anticipated. And hence, our volatility was lower than the 8 to 10% that I thought we would have. So last year was kind of the inverse of 2008. Last year was very low volatility with a 22% return. That was great. Obviously losing 37% with a 40% volatility, that was terrible. So, but the secret is you have to be able to survive those. And so, we're doing the same kind of thing as long-term capital. I don't want to make it out that we have found some super double secret. We're doing the same kind of thing they did. It's just we've been able to survive. And you can see here, we began at $1 and now the share price is about $17.50. So it's been a great run, but it's had its shaky or scary moments. I'm happy to take any questions or whatever you wish.
Sounds great, Bob. Thank you very much for the insightful presentation. If anyone has any questions, please feel free to unmute yourself and ask. Also, and just to kick it off, I'm curious, how has your approach to investing and managing your fund in general evolved over the years, Bob?
Could you, I'm just, somehow my audio.
So how has your approach to investing evolved over the years and of course, managing people too?
Yeah, so I would say it really hasn't changed. So obviously the world changed. The underlying theme hasn't changed. So just go into this concept here of, hey, I have one bond that yields 5%, one bond that yields 2.5%. I'm going to put that trade on and I'm just going to sit and wait to sort out. That underlying concept, that hasn't changed. Now, the different things that happen around the world, the names change and the circumstances change. So for example, let's say another example was Japan. Japan said, for a long time said, we want 10-year yields to be 0%. So those yields got incredibly distorted relative to the other parts of the yield curve because Bank of Japan said, we want 10-year yields to be 0, and those yields are going to be 0. They're not exactly 0, but they're awfully close to 0. Now that has changed now. They're about to change all of that. But that being another example. So the theme is the exact same. We're looking for mispricings around the world for crazy things that are happening. We hold about 15 to 20 trades at the time of weird things that are happening in kind of, let's say, the 20 biggest markets of the world. And we can usually find things and, we're happy with the positions. But so the concept doesn't change, but the names change all the time. So right now in the US, this graph doesn't go out to currently, but in the US, TIPS versus treasuries is very efficiently priced. We have no position in TIPS versus treasuries. So the names change, but the principle is the exact same. And then you ask about like managing people. One of my weaknesses or my Achilles heel is delegation. I'm not good at that. And I don't enjoy managing people. So we don't have a huge team. The thing that I love is coming to work and looking at trades like this and reading research and reading the newspaper. That's what I enjoy about my job. I don't enjoy bossing people around or telling people what to do. And so that is a weakness, and it's just that I have made a lifestyle decision as to that's how Barnegat is.
If anyone has any questions, please feel free to unmute and ask.
Thanks, Bob, for taking the time. Ed Huang here. Apologies, I'm traveling, so if there's any background noise. How do you think about position sizing? It sounds like you've got a huge amount of excess collateral, and your positions, when you have them, would be relatively a small percentage of the overall fund. Love to hear your thoughts on that.
Yeah, sure. So here on this, so we're looking to have a volatility of our share price. So again, this volatility is measured just like, I don't know, if you had an option on Microsoft, the way they measure Microsoft volatility is they just look at the share price every day and they say, this is how much that share price moves on a 1 day or 1 year volatility. So we're aiming for an 8 to 10% volatility over the long haul. And again, that theme comes from, and not that these numbers have any magic quality to them, but just I thought, hey, if I have 50% of the fund sitting on the side and we have volatility of 8 to 10%, that's going to need a 5 to 6 annual standard deviation event to make me change, to make me do something to try and free up even more collateral. So I thought that was a big enough cushion. And so far it has been. 2008 got tricky, but the other 22 out of 23 years, it has worked perfectly. So on your question, how do we do position sizing? We have 15 to 20 trades at any one time. And then we know the volatility of the individual trades. Now, clearly that can change, but we make some estimate. And that's one thing that Bloomberg is very good at, is showing you what's the volatility of a relationship between, like here, this tips versus treasuries. Tips moved about 4 to 5 basis points was their daily standard deviation during the chaos of 2008, 2009 relative to treasuries. So kind of that's the volatility of that relationship. So we look at it. What is the volatility on individual trades? What are the correlations between those trades? And then we get the volatility for the fund. So there's nothing saying that we have this nailed down. It can easily change. And 2008 here is a perfect example. I'm aiming for 8 to 10%, and we have print 41.7. So there's nothing etched in stone that says it's going to work perfectly. But and then same thing too on the correlations. Correlations can change quickly as well. But on the positive side, you can see 22 of the 23 years have worked just as we have hoped. They're very close to that 8 to 10% target. So that is how we look at the sizings. In the end, we want the fund to be 8 to 10% volatility. We have to look at the individual pieces, correlations between those pieces to get the fund's volatility. And 22 out of 23 years, we've got it right. 1 out of 23 years, we got it wrong. And then one other important note, just on your question on fund sizing, when we have better opportunities, we want to have more trades. We're going to overshoot that 8 to 10%. So 2009 here is a perfect example. We had incredible opportunities in 2009. And same thing, after long-term went under 2001. Our volatility is going to be higher because we put on more trades because we have incredible opportunities. Conversely, like here, 2000, just before the crisis, we didn't have as many opportunities and our volatility was lower than the 80% because we just put on smaller trades. We don't have as much to do, and we're happy to just kind of sit there and be patient for a while. Now, and then occasionally, like this year, we do have pretty good opportunities, and just volatility comes out lower than I anticipated, just because our correlations, it worked out even better than I had hoped. You kind of come in with these expectations, and sometimes it's worse, like 2008, and sometimes it's better, like last year.
Thank you so much.
Do you have any other questions from the audience? If not, I'm curious, Bob, about the trade that you mentioned before, tips. What about carry? Is that a big part of, how you evaluate trades? What do you think was the carry on that particular trade? Was it?
Yeah, so carry is important to us. So carry, just so you know, the way I describe carry is what happens if we come back a year from now, and this is an important point. Thank you for bringing this up. What happens if we come back a year from now and none of the yields change? So just going back to this example, you look at this trade, and so we're taking in the 3.74 and the 1.36. So we're taking in about 5%, and we're paying out 2.5%. In a weird way, everybody on Wall Street says, oh, I'm going to put this trade on. Here's going to be the catalyst, and it's going to move in my favor. In a twisted way, we almost hope that that thing never corrects, because then you have the world's greatest Sharpe ratio product. Imagine if this mispricing here just remained mispriced, and we just were taken in. It was kind of like a machine. We just take in 5% each year. We pay out 2.5% each year. So that is what I call carry. As if we came back a year from now and the yields didn't change, it didn't move for us at all, we would have still made, at the time, our basket of trades in 2008, our carry was about 20%. That was the greatest it's ever been. Right now, we're at about 9 to 10%, which is still pretty good. The greatest ever was 2008, 2009. Currently, I'm very happy with 9 to 10%. But that's an important point of what happens if, here you can see we had the trade on, it went against us, and then it went for us for another 3 years. So if it goes for you for the 3 years, you get to monetize it more quickly, which is obviously nice. I don't want to complain about that. But the important point I want to make is that, let's say it remains mispriced and it's just still 5% versus 2.5% and nothing changes. There are some trades like that are just mispriced and remain mispriced, and we just sit there and collect the coupons. From a Sharpe ratio point of view, as in little volatility because it just remains mispriced, and you're clipping these coupons. Remember, the cost is zero, so you're just clipping these coupons with a cost of zero. Sharpe ratio wise, that's the promised land. So it's not so bad if the world just kind of freezes in a wacky place. That's not the worst thing. The risk to Barnegat is what happened here. We put it on at 125 basis points mispriced. It goes to 250 basis points mispriced. That hurt. We suffered losses. But the idea of, hey, it's wacky and mispriced and remains wacky and mispriced, that is ironically a great situation. So 2008 was the best ever at about 20%, as in if we came back a year from now, nothing changed, we would have made about 20%. Currently, our fund is about 9 to 10%, and that was one of the things that really helped us last year when we made the 22%. So a lot of last year, people ask me, oh, how did you do so well in 2023? And, people want an exciting answer, like Soros says, hey, I broke the Bank of England, and I made $1 billion. Our stuff isn't that exciting. Really, most of what happened last year is we got these mispricings, and the mispricings didn't change, and we just sat there and collected coupons, which is my favorite type of year. Just we put the trade on, remains mispriced, and we collect the coupons.
In addition to being a hedge fund manager, you're also an entrepreneur, Bob. So I'm curious, how did you get your first investor in the aftermath of LTCM, especially since you were actually following their strategy?
Yeah, so that I would say I'm not very good at. So I would not suggest doing it like I did. So I was at a fund in London, and that fund, had some trouble. And so in my mind, and this was all incorrect, in my mind, I thought I could go out and show people a presentation like this with these incredible mispricings, because we had also incredible mispricings in 99, 2000, 2001 after long-term went under. I thought I could go out and show people these incredible mispricings, and that they would just trip over themselves racing into my fund. I put my own money in the fund, had a share price. It worked great, just as like I had hoped, but nobody wanted to touch fixed income arb because long-term capital I think they had 2 Nobel Prize winners, just went bust and took the share price to zero. Nobody wanted to touch it. Now, the tough part is that's the best time to invest in something. When nobody wants to touch it and the mispricings are so large and people are scared of it, that's the best time to invest. And it was a great time, but nobody wanted to invest in it. So I went 2 years, I put all my own money in it, and I lived in a walk-in closet on Bleecker Street in the city, and I couldn't afford Bloomberg. And so I went to the New York Public Library to use Bloomberg, and I would write down the prices, carry them home, and type them into my computer. It was rough. But you know what? Like I had this dream of Barnegat, but I also, again, I had to be able to hold the trade. So I didn't want to take money out of the fund. So I drove, luckily I was a bachelor. I drove all my expenses to zero. And just one of my friends was kind enough to share a walk-in closet, and I just lived there. And it was a tough time. I don't want to underestimate, 2 years of zero income. Zero is zero. It is tough. And so in the end, it all worked great eventually. So what I did was I gave myself a share price, and I just had a very clear, I put this much money in the fund. and I have this many shares, and so here's the share price. And then I just gave myself a website, and I just updated the share price every day. And then anytime in the newspaper, I would read of, I don't know, so-and-so sold their company for $10 billion, and they're, looking at investments, for their 10 billion or whatever it is. And I would send them a email or a snail mail or whatever I could. And I didn't know these people, I had a few contacts, but I didn't really know anyone. So I was snail mailing everybody saying, hey, I have these opportunities, presentation just like this. I have all these great opportunities, all these great mispricings, and, I think it'd be a good investment. And, at the time, the share price was $1, and now the share price is $17. So that proved to be true. But, one funny thing, one of the people who didn't invest in 99 and 2000 just recently, and had the chance to invest at $1, they recently invested, with the share price up at like $15, $16, which I'm grateful for. But it's just, you never know how it's going to work. And the other thing, too, I wouldn't underestimate. Everybody wants to invest in a winning fund. Nobody wants to invest in someone they've never heard of. So marketing is very important, and we are weak at it. I wouldn't recommend it. I wouldn't recommend following my advice on marketing.
Bob, got another question. How do you go about sourcing these ideas? You talk about a lot about spending a lot of time reading newspapers and the like. It sounds like you have to be on top of many things across the world. I'd love to hear more about, I guess, the idea generation process.
Sure. So the one thing is we have fantastic IT. So the thing, I mentioned Barnegat's very weak at marketing. One thing we're fantastic at is IT. So our IT guy, or our IT gang, is very good at gathering the information from around the world and presenting it in a very clear fashion to the traders. So that is very good. And then on your question of idea generation, or that is very helpful. On the question of idea generation, I guess one of the things that I just enjoy is reading the newspaper, reading The Economist, reading the Financial Times, just going through current events. So just to give you an example of Switzerland used to have a peg to the euro. And Switzerland had a kind of a unique problem that everybody kept, and this in particular was exaggerated after the global financial crisis. Everybody was worried about the world and kept putting money into Switzerland. So they would, let's say, sell off their Russian rubles and buy a zillion Swiss francs and either move to Switzerland or just keep their money in Switzerland at a very safe place. So the Swiss franc kept appreciating, and the Swiss central bank had a problem of their currency keeps appreciating, so their inflation keeps going to zero, and they, just like everybody else, wants to have 2% inflation. So they have this unique problem that everyone just keeps pouring money into their country. So one of the things they said is, first of all, we're going to peg our currency to the euro. And the people that are hurting us on appreciating the currency are these futures momentum funds. We want to stop them from buying Swiss francs like 3 months in the future, 6 months in the future. And the way we're going to do that is we're going to put a peg in place so the currency won't appreciate. And two, we're going to drive our forward interest rates negative. Now, that has happened in a lot of countries, but at the time, it hadn't happened anywhere. They were the first ones to do this. And so they said, hey, we're going to drive the interest rates negative. And so that kind of thing sets off alarm bells at Barnegat of, boy, how are they going to do that? How are you going to have the short-term rate at zero and then your future interest rates below zero? And so that's the kind of thing we look at. And the way they were going to do that was just intervene in the forward FX market. And so Barnegat would deposit money at zero effectively at the central bank, which normally you think receiving zero, well, that's good for nothing. But if you can borrow money at a negative interest rate, well, receiving zero is good for something. And so that being another example of a trade. But so that's kind of where I come from. That is just, that's how we read the paper. We're looking for certain things that, like, oh boy, that's going to create a mispricing. There's no set formula for it, but I guess I just enjoy reading the paper, enjoy reading FT, economist, all those things, and they will highlight weird things going on around the world. And then we are quite good at gathering that information and looking for mispricings.
Great, thank you. It sounds like just a lot of, you're looking a lot for government interventions and one-off, like say Lehman events, those kind of things
Yes,
to really drive it. Yeah.
One of my coworkers phrased Barnegat as a perpetual series of one-offs, which isn't so far from the truth. That's a pretty good description. So now the one thing, just on the government intervention, some of the examples I've given, like Switzerland or the Bank of England quantitative easing, those are government interventions. But there's, like tips versus treasuries, that's just a panic, as in the world panics and unloads tips and buys treasuries. So that's not so much a government intervention. So yes, government intervention surely helps us. It's a great source of trades. I just don't want to seem like they're all government interventions. There's plenty of other wacky things going on in the world in addition to government interventions.
Sure, thank you.
Do we have any other questions from the audience? Okay. So if not, let me just, on behalf of the IM Club, thank you, Bob, for speaking with us and for the really insightful presentation. We really appreciate it. And thank you to the audience for joining us today.
Thank you very much.
Thank you. Take care.
Bye-bye.
Bye.
Thank you, Bob.
Thank you.